Okay, hello and welcome to the latest Facebook Live that we are doing for everybody in the community. We will share bits of this to or with other people outside of the Facebook community. It's good to have you all here. What I'm going to do is a bit to get a few people to join us, and then I'll start the video, because Facebook always has a habit when we export these videos cutting off the beginning part. So just like last time, what we'll do is we will go through the questions that you sent in. I will try and answer them in group together, so try and keep all the investment ones together. Actually, most of them are investment related, so we'll rattle through those. Hopefully you can all hear and see me now. Yeah, I just had confirmation from the other people at Money to the Masses that they can hear me, which is great. So what I'll do is I will just crack on. If you want to ask any questions while I'm doing this, then of course you can do down in the sort of bottom. There's a comment section there. Write your questions in there, and I've got probably about 20 questions to go through. As usual, normal caveats: ignore any noises, any cats crying, any children flying in trying to get onto the Facebook Live, because of course this is done at home as we are all in isolation and lockdown. You can see this is my living room in the background. I should perhaps put a big Money to the Masses sign on that wall, but I don't think my wife would let me. So I'll start with the questions and start going through them. Some great questions. Most of them are, as I say, related to investing. So in no particular order, the first question is, I would love you to talk more about the long-term investing strategy of pound cost averaging, drip feeding money into the market versus biding your time and lump sum investing when the market suits you. Having read various things online, including the likely pitfalls that come with trying to time the market, I'm currently sitting on a bit of cash in stocks and shares and a sip, but trying to figure out the best strategy. Thanks, and keep up the good work. I'm not going to dwell too much on this one, actually, because I've covered this in previous Facebook Live sort of shows. But what I will say is the research has been shown, and we've done research for 80/20 investment members. Pound cost averaging is where you invest in installments over time. So rather than going in as a lump sum straight away, you will invest in installments. So if let's say you had £10,000, rather than putting £10,000 in today, you may decide to put £1,000 in every month for 10 months. And what will happen is, if the market tumbles, you will buy more shares each month with your £1,000, because the price of the shares are falling. Then what will happen when the market eventually recovers, which it inevitably will do, the number of shares you have is higher than if you just put £10,000 at the start, and therefore the value of your portfolio will be higher if you've drip fed in. Of course, the downside of that is, if markets suddenly take off and rally, you would have been better off putting all your money in at the start. But the issue is you don't know which you're going to get. So the reason why pound cost averaging and dripping money in is attractive. It's a strategy that allows you to almost hedge your bets, really. So you are investing in the market, but you're not chucking all your money in at one point. So it's a simple strategy for some people. If you're excuse me, for some people, if your investment time frame is incredibly long, then actually the length of the time you invested starts to have more of an impact than the actual point at which you entered, if that makes sense. So if you're invested for 30-40 years, the actual amount of money you put in on day one, or if you drip fed in, the differential starts to reduce, because actually the impact of compounding all the returns later on actually has a far bigger impact. So if you want to know more, then do go on Money to the Masses. I've done articles on it, and in fact I did do a whole editorial piece, a column for MoneyWise online. So if you Google MoneyWise online and Damien Fay, there's a whole article where I explain it and give you examples and actually show you what happened over the best and worst periods of time in the stock market if you're investing. And the next question is, are the days of buy and hold over? Now, I'm guessing the person who's asking this is meaning that if you had bought and hold, say, the FTSE 100 if you look at the chart, it's gone nowhere. If you go back sort of 5 years, it's basically where it was before. And for some stock markets, they've not really made much headway in the last decade. Now we've had this severe sell-off. Of course, that does overlook the idea or the notion of dividends and income that compound over time. So that when you take into account the income you receive and can be compounded when you reinvest it automatically, then you have made a positive return. Don't forget, the FTSE 100 is an index that is just its price. We're following price. So therefore, just because the price hasn't gone up, you've actually earned an income from holdings if you've been investing. So is buy and hold over? I'm not sure it's over, but what I think it has done is got people to question the merits of just simply buying and holding one thing and not reviewing their portfolio. I think a sell-off, don't forget, this is the first time in 11, 12 years that we've had such a severe correction. And I think for a lot of people who they haven't experienced anything other than a bull market, so they've only experienced since March 2009 a stock market that's basically gone straight up. And that means that this is quite nerve-wracking for them. So buy and hold, I don't think has gone anywhere. All it means is that people might want to start to review their portfolios periodically. I mean, it depends on your individual circumstances, but just reviewing your portfolio once a year has been shown to have an impact on returns, a positive impact. And that was based on, again, some research I did for 80/20 investor members. The next question I've got is regarding rebalancing. And the question is, taking the start date of the 1st of January 2020, which portfolio would give you the best return? Vanguard Life Strategy 60 equity, or B, two separate 60/40 funds that are bought and hold? Now, I'm interpreting this question because this is what they're really asking, I think, is if you'd have just bought an equity fund, or you just bought, and alongside that bought a bond fund, so you had 60% in the equity fund, 40% in the bond fund, could you have done better than a Vanguard 60% equity strategy, which kind of does the same thing? Now, the answer is it depends, because it depends which one you have bought. Now, in the beginning parts of the sell-off, the Vanguard fund actually struggled a bit. Since probably the beginning of March to now, it's actually done well, and that's partly because it's got an investment in US equity. It's quite a large investment. It's got exposure to the US dollar pound currency exchange rate. So if you have looked at we're not traveling anywhere, are we? So you've probably not looked at the pound dollar exchange rate, but if you have, it's crashed. We were up about $1.30 before the coronavirus sell-off. We're now down sort of 120. I think we're about 124 now, but we were down as low as about $1.17. Of course, that boosts any holdings that are overseas. And for a Vanguard fund that has exposure to that exchange rate, that boosted performance. So it has done well. The answer to your question, it does depend on which funds that you would have bought. You could have bought an equity-based fund, especially a global one, or you could have bought a bond fund and combined them and outperformed it. But that's just the benefit of hindsight. Vanguard is just one fund out there. A lot of people look at it, but it is only one fund. There are funds that have outperformed it. There are lots that have underperformed it. But interestingly, something I'm going to touch upon during the podcast this week, actually, which I'll record after this video, is that ethical funds have done particularly well in this sell-off. And I'm going to explain why that is. It's something to do with the way that they invest. Now, I'm just seeing on here a few people saying hello. Mel James, I say a quick hello. Donald Sellers, watching with interest from Oxford. It's Cigar, I think it is, loves listening to your podcast. I'm enjoying your Facebook live sessions as well. S from Surrey. Good to see lots of people joining the Facebook Live right now. I'm going to continue through the questions. If there's anything else you want to know, it doesn't have to be even money related. I'm quite happy to talk about it. Next question I had is, I would be interested in cash versus gold versus equity investments just now with market turbulence, and what split would you suggest? Now, I wouldn't suggest one because obviously I can't give people advice, but the performance, later on somebody also asked the question, they wanted to know the performance of gold versus equity markets versus cash during this period. And I've actually before this produced a chart that shows those performance numbers. And what we have, you'll see that, for example, the FTSE 100 year to date is down about 24%. If you look at the S&P 500, it's down in double digits. It's less. It's not down as much as the FTSE 100. I think it's about sort of 14, 15%. It depends which day you look at, because we've had a very strong rally. The thing there is, like I mentioned in the previous answer, the global overseas holdings will have had a boost from fall in the value of the pound. So that's why some of the overseas markets have done better than the FTSE 100. But the FTSE 100 does also have quite a big exposure to oil companies as well, which obviously the price of oil has fallen 70% year to date. Now, cash has obviously performed well, because if you've got your money in cash, it hasn't fallen, and therefore at this point in time, you're still winning. Bonds have also done well. If you look at gilt funds, you'd have probably been up about 10%, I think it is, year to date. And gold, you'll be up even more. I think you're up about 14% year to date. So these are haven assets that have performed well when the market has tumbled. It doesn't mean they haven't fallen along the way. We've seen periods of forced liquidation by hedge funds around the world, which caused the price of gold and the price of bonds to fall. But what it does highlight is that even though there can be a bear market in equities, the investment world is made up of lots of assets. So there are bull markets in gold, and there are bull markets in US treasuries and certain parts of the bond market. So there are places where you can invest and be making money even through periods that we've had. Now, the question about how much gold you should have is an interesting one. About a year or two ago, I did a whole research piece on 80/20 Investor around the idea of gold, because you see a lot of stuff in the press that says buy gold, hold gold, it's a hedge against inflation. It seems the way they talk about it, it's a hedge against everything, and it's not. The problem with gold is, as Warren Buffett once said, is basically if you buy it, it's normally bought in periods of fear by people, and you're hoping that somebody further down the line is going to be more fearful than you are at that point and pay you a higher price for it. Because gold in itself doesn't actually do a lot. It doesn't produce an income. As a metal, it's not used massively in production. It is to a point. I know there are some uses for it in gold, but when it comes to investing, a lot of the demand is driven by people who go into it as a haven asset. The problem is with gold is that if you look at the chart for gold and the gold price, so if you go on to Google, just Google the gold spot price, and you can find it on things like Bloomberg, you will see that the price of gold is incredibly volatile. It goes up and down almost like the stock market. And so as a hedge against volatility, it doesn't work in the way you might think, because the more gold you have in a portfolio, there comes a point as you keep adding gold that you actually start to increase the volatility of your portfolio. So it isn't a hedge against volatility at all. So yes, in periods that we've had now when there's mass fear, and it's a real extreme fear, gold does well, but it is volatile. Gold does, if you put it in a portfolio, help to reduce the size of your maximum losses to a point. But again, if you hold too much, then it starts to increase them. When you did the numbers, I crunched portfolio numbers and did it for different percentages of gold. And if you had 5%, 10%, all the way up to like 50, 60, see what would happen. And it worked out that if you hold more than 5 to 10% of your portfolio in gold, then you start to increase the frequency of your losses and also the frequency of your gains. But what it means is your volatility starts to go up. So it can start to be counterproductive, because we have seen some wild swings in the price of gold. So if people want to buy gold, then I think some of the conventional wisdoms out there of only holding 5, 10% have actually got a grain of truth in them. So I can't say whether you should, or that's down to you whether you buy gold, but just bear those things in mind. There's a lot more people saying, Wayne saying great work. Hello, Wayne. Amit, oh, good to see Amit there, prompting you to post questions. This is an interesting one. I'm deviating onto one here. And Wayne's asked a question: why is there such a severe disconnect between the real economy and the stock market? Is it purely the UK Bank of England stimulus or the US Treasury? Now, this is a question that I was talking about this very thing with the rest of the team at Money to the Masses yesterday. So if we look at America, now you may not watch the news and the financial stuff as much as I do, because obviously it's what I do for a living. But yesterday we had confirmation that the number of people who effectively have claimed or put claims in for unemployment benefits in the US had risen to 20 million in the last 3 weeks. That's 20 million new people who are effectively registering themselves as unemployed. That is a mind-boggling number. To put that into context, that would be about 14% of the US working population at that point. And even more mind-boggling is that if you look at the financial crisis, so going back to like the bottom of the financial crisis in 2009, all of the jobs that have been created since then, the 20 million plus jobs as the economy boomed and everybody was happy when the stimulus from all the central banks was flowing around the world, and particularly in America, all of the jobs that have been created over that sort of 11-year period have been effectively wiped out in 3 weeks. I mean, the chart is completely mind-boggling. But you then look at the US stock market, and we are seeing it rallying up sort of 20+% in a matter of weeks and even days. I think it's the futures today are looking like they're going to open about 3.5% because Donald Trump did a speech about how he's going to open up the US economy last night. And we also had some news about tests on a drug that's being used in an American hospital that's helping people to recover supposedly quicker from the coronavirus. So chuck all that in. What you get is an unbelievable disconnect, and in my own head it is quite hard to put the two together. As I've mentioned before, the stock market anywhere is a discount mechanism, so they will always look 3-6 months ahead, and so they will be thinking that that hopefully the economy will be rebounding and be closer to normal, back to normal in that period. So the stock market always bounces and finds its low before the economic low, so it will be looking at the future. So they are pricing in some future that is going to be extremely positive. Yes, I think that is optimistic. At some point, either they're going to be proved right, or the economic reality is going to catch up and we're going to have the market pull back again. If you look at valuations, and I think somebody asked later on about valuations of stocks at the moment are starting to creep back to where they were at the beginning of the year. So the amount you're paying really for the earnings that companies are going to produce are almost heading back to where we were before we had this sell-off, which again is mind-boggling because we've got 20 million people unemployed, millions of businesses that are struggling I'm talking about in the US here, but we're going to have this pattern reflected in the UK once the numbers come through after all the furloughing has been stopped. So the reason that the disconnect is because people are being optimistic. There is a case of the fear of missing out, FOMO. When the market rallies, they want to call the bottom, and it could be that they will be proved right. But the other big thing, as you hint towards, is the stimulus. The amount of stimulus that's being put into the US economy, particularly into the bond market in America. Now, the bond market is basically one of the lowest risk assets out there. So if you imagine like a skyscraper, if the foundations are secure, the top floors won't wobble as much and the building will stand up. If the bond market is shaking all over the place, then the building is likely to fall down. It'll be bad news for equities on the top floor. The Treasury and all that have basically backstopped a lot of the bond market and are making sure that it's stabilizing. So that's having a big impact. So that's the disconnect. Why it's happening is because of the stimulus. People are being overly optimistic. They don't want to miss out. Perhaps they will be proven right. We are at the crunch point where we're probably going to find out whether this rally we've seen in recent weeks is genuine or if it's actually, again, something of a bear market rally. I'll go deviate off here. What do you think of interest rates? What do you think let me start that again, Sue. Hi, Damien. What do you think interest rates will do in the next couple of years? Crystal ball time. I'm remortgaging, tempted by a 5-year fix for the first time in my life. Of course, as you suggest, I don't know where interest rates will go, but go and have a look at what happened in the aftermath of the financial crisis. This is going to be a recession. The numbers they're talking about with like a contraction into sort of 10, 20% of economic, in terms of GDP, economic growth for a lot of developed world economies. We are going to probably see a very deep recession. Some people are talking about a depression that we haven't seen for 100 years. The interest rates never got back to anywhere near where they were after the financial crisis. So the odds of them doing it this time around are very low indeed. We've not actually risen, they've not risen back towards that sort of 5% level where you would normally think they would live. So all I'm saying is that the lower for longer regime, history shows us that is probably where we're going to be. And given that we aren't out of this yet, then I think we are going to see interest rates lower for longer. But it does mean that you will get some great. Do I think interest rates are going to rally quickly and soon? It's hard to tell because if inflation picks up, it could do, but history suggests that the odds are on the side of interest rates being lower for longer. Right, let me quickly go through, there's some good questions on here, some about buying property. I'll rattle through some of the other questions I've had from people who posted them in beforehand. Somebody has asked, I would love to hear more. Hello, I would love to hear more about income investing, e.g. options, how best to structure an income producing portfolio, what to pay attention to. Also, is it a good idea at all for someone with lots of time ahead and not huge amounts of money to chase income, or is it better to invest for growth in this situation and forget about income until substantial amounts of money is accumulated? Now, I'm going to take that from the angle of how to produce an income portfolio, because there are things that you should try and do. So if you're trying to produce an income from a portfolio, you can buy shares. And the big problem we've got at the moment, as I spoke about a couple of weeks ago, is that companies are cutting their dividends. So they're not either lowering guidance, saying they won't actually be paying out a dividend, or they've actually stopped doing it at all. So for people who buy shares in companies, direct dividend, and then to use that to live off, that's obviously going to be proving difficult. And of course, the value of those shares have fallen anyway. That's a secondary consideration if you're just living off the yield. So all you're worried about is the income. You're not buying and selling these shares. The thing is to buy funds, income producing funds. You can buy particularly equity income in the UK, global equity income funds, and what they will do is invest in lots of companies, 50 to 100 in each fund, and they will take the dividends that come in from the shares that they hold, and they will produce a payout to investors. So the payouts tend to be more stable and much more diversified. So even those funds will start to see their payouts drop. It's almost inconceivable that they wouldn't, because of the way particularly unit trusts I'm talking about here are structured and the way they are able to pay income out. When we produce research on 80/20 Investor, one of the things that I've done is produce an income heat map. So it's like a heat map with different colors for each year going back before the financial crisis. And it tells you who has grown their dividend year on year, who has cut it, who has kept it the same. So visually, you can quickly see funds that have grown their dividend year on year, because if you're investing for income and you want to live off that income, you want it to grow to beat inflation. Otherwise, what will happen is your income will lose value. It will actually, purchasing power will drop. So the thing you want to look at is, of course, you look at yield, because that's about the amount of money that you could potentially, or the percentage income you could get from the amount you spend to buy a fund or share. But of course, in this environment, that yield figure is going to be probably unreliable. And so you want to look at payouts, really, how consistent they've been in payouts, and particularly focus on the financial crisis, because if a fund had managed to keep its dividends and payouts going through that period, then it has a probably better chance of doing so now, because it's done it through a previous bad period. Think globally when you're building portfolios. That's the other thing, because people always focus on the UK. To give you an example, over in Japan, a lot of companies in Japan are very cash heavy. They have been for a long time, had a lot of cash on their their books. And while their dividends they were paying out were low by comparison to other companies around the world, it does mean their dividends now are going to be much more sustainable. Yeah, it may only be about 2%, but it may be more sustainable because they've actually got the money to pay out. So look globally, because you could benefit from diversifying your income stream. The other thing I would say is do look at investment trusts. Now, investment trusts work well because the way they're structured is they are able to hold back income and smooth out their income payments over time. And unlike unit trust, that means that they, even in years where they have a hit to their income that they receive, the dividends, they can increase their payouts to the investors who hold shares in their investment trust. Now, on the heat maps I did for the investment trust world, what you can see, there are investment trusts out there that have never cut their dividends. They've grown them year upon year upon year. So there are ways out there in which you can get investments funds that have shown a history of producing a reliable income. Doesn't mean they always will. The other thing to do is make sure, if you're looking at investment trusts, you can find on the Association of Investment Companies, the AIC, they have or they list all the investment trusts, and you can see something called the reserve or revenue reserve cover, and it tells you the amount of money they've got and how many years worth of dividend they could afford to cover from their existing cash. And it's normally stated in years, so 0.8 is about the average. So you can get insight into investment trusts, how likely they are to be able to cover future payouts. And the other thing I'd mention before I move on is if you're an income investor, if you're living off the income that's being produced by a portfolio, it makes sense to have a cash buffer. So you have 1 to 2 years worth of income in a cash buffer, which may be within your investment platform that you use, and the yield that is naturally produced by the investments drops into that cash buffer, but you actually draw your income from the cash part. So if you have a period like now where the income being produced by the investments actually falls, you can still draw from your cash reserve here, but you don't have to cash in your investments at a lower price. So if you're living off the income, you're not so bothered about the value of the shares themselves. You're more bothered about the ability for the investments to produce a reliable income. Somebody's asked me here, which is I'm not sure I'm going to answer this one, but do I think Tesla is right to pay out dividends while so many other companies have cancelled? Now, this is something that what will happen is there will be a period of people look back on history and they will see whether companies were right to do what they've done. Now, the banks have been told that they shouldn't be paying out dividends. Of course, there are companies out there that have made money in this environment, have benefited, supermarkets being one. The issue is that, of course, their costs have gone up because they've had to recruit people as well. So it's not a simple it's not as simple as just saying, well, they're making more money, because their costs have gone up quite a lot in order to be able to provide the services that they do. Yes, they have benefited from cuts in business rates, and we will only see in time, because Tesco actually put out some results recently which focused very heavily on their costs, and so was trying to drive that message down that through that they aren't basically making hay while the sun shines. So I think what will happen is, I'm not going to say whether they're right or wrong. They're a business after all. They're entitled to pay dividends. I think what people will look back and make judgments on a lot of companies about how they behaved during this period. Let me just have a look at some of the questions that you've just sent in. Hi, Damien. What advice would you give a first-time buyer looking to purchase a property in the next 12 to 18 months? Now, I think the message at the moment from the people I talk to who are in the industry, whether it's the mortgage industry, whether it's in the property estate agency market, then I think the message is, if you're that far ahead, you just carry on saving your deposit and it's business as usual for you. What will happen to the market when we all come back? No one really knows. I think there's still interest in people wanting to move house, but they just can't at the moment. And yes, house prices may take a dip, but we just don't know. I see a lot of reports saying house prices are going to fall like 10-15%, but I think that's very much putting your finger in the air. So The positive thing I want to say to Miriam is that if you're a first-time buyer looking to purchase a property in the next 12 to 18 months, then it isn't a bad thing, because you could be in a position of strength, assuming that you are able to secure a mortgage. Yes, lending may be a little bit stricter. We don't know till we get there. But for you, I would just concentrate on still saving for a mortgage, and then we will see what happens when the economy starts to open up, hopefully in the next couple of months. Right. There's a nice message from Julian saying thank you for all the things they've done. Actually, yeah, because they've mentioned the MOT there. So if you've not done an MOT, then we go onto the website. You will find a link to Damien's Money MOT, which reviews all your finances. It's not just about investing. It's focused mainly on everything else. Investment is only part of it, but it looks at your spending, your budgeting, whether you should have wills. It therefore gives you a score, gives you an overview, shows you how you compare to other people, and shows you how you can improve it. And you can have an action plan, an email action plan, giving you quick, easy ways to improve it. So do have a look at that. Thank you for that feedback, Julian. On the questions, I'll continue down the remainder of these questions. Hi, Damien. Would be good to know the probability of the markets crashing again relatively soon. I personally don't see how they continue to go up like they have in the past, especially if a deep recession starts later this year. I think I've already covered that one on the previous answer that I had come through the comments. This is an interesting question. Hi, Damien. Do you agree with the old adage about asset allocation, 100 minus your age for equity exposure? If not, what would be your method of asset allocation? Now, to explain to people who don't know what this is, the theory, the sort of adage, is that you take your age. So if you're 40, you minus that from the number 100, which would give you 60, and your equity exposure in your portfolio should be around 60%. It's not a hard and fast rule. It's a bit of a finger in the air type of rule. The other 40% would be in lower risk assets. Now, it's a good starting point for somebody who would be a medium risk type of investor, because what this rule doesn't allow for is the individual risk levels and their people's own fears and their own. It's not personalized for anybody. So you may have the example I gave, somebody who was 40, they may be really risk averse. Well, they won't want 60% equity exposure. They can have far less, or should have far less. So they would need to adjust it. Now, what do I think about the rule? I actually think, as a basis, I think it's a good starting point. Now, I remember when I used to work in the city, and we used to go and see some of the investment banks and look at what they were doing, and they were seeing the very rich clients that the company I worked for had. And these guys were earning, guys and ladies, there was lawyers, they were earning millions of pounds a year. And I'd never met people so rich. And when we went to them with the discretionary fund managers who had all their very clever ways of investing money, and they had a very clever and expensive investments, I did almost laugh inwardly when I was talking to one of them, one of the investment banks, and at their heart of what they did was this basic principle. Now, I'm not saying they all do this, but it is something that is used as a gauge by some of the investment banks out there as a basis of trying to get people to understand risk and how much they should take. So it's not something that is outlandish. To give you an example of how you might adjust this, if you go to Money to the Masses and you look for our investment calculator, I actually built a calculator based upon this principle that's based around this whole what age you are, and then allows you to move it up and down based on your risk tolerance to see how your asset allocation might vary. So it will show you the potential asset allocation in global equities, UK equities, and it's based upon some of the leading ETFs that are out there that have, say, 60, 80%, 100% equity exposure. And so that shows you, if you move up and down the levels, what a diversified portfolio could look like if you wanted 60% equity exposure. So it kind of takes this rule and takes it onto another level. So I think personally it's a very good starting point. It's not a hard and fast rule. It's much more important that you pay attention to your own risk tolerance and your own personal circumstances when you build a portfolio. And there are a number of tools out there that help you do that to a much more accurate degree, a bit more Q&A and questionnaires that come up with a risk portfolio. And I mean, I'll post a link to one after this Q&A. Somebody has put in here the next question, quick question about workplace pensions. In recent weeks, I've lost up to 25% of the value of my pot. I'm in a position to increase my contributions. Would this be a good time to do so, buying at lower prices, and hopefully a big bounce back happens when the crisis eventually ends? Or should I just sit and wait? I'm 55, 11 years from retirement. Thank you and take care. Now, this is again another good question. The point is, don't try and time the market. So my view on all of these, no, this is not advice again, is that this person is 11 years from retirement. Go back 11 years and we were at the financial crisis. So with two financial crises effectively in that space of time. So it shows you how long this person has got until they retire for markets to recover. So investing now when you have a long time frame isn't a bad idea at all. Not trying to time the market, it's about being able to contribute more, top up your pension. And if you should do so personally, I think if you do things in a, not necessarily trying to time the market, but a logical, planned way. You've worked out that you can afford to make the extra pension contributions. You've looked at what it means potentially to your retirement plan, and it's all part of a brighter plan. The fact that you can now up your pension contributions can only be a positive if you want to use your pension pot, obviously, when you retire at 65, judging by, or 66, judging by what you put in here. So it's not the worst thing in the world to do. You probably benefit from pound cost averaging that I talked about at the start of this Q&A. So yeah, it's a very good question. Going down to some of the later questions I've had, again on investing, somebody's put, I'd like to ask a question about investing to be financially free. My goal is to retire early. In order to do that, would it be best to invest more in a pension or into an investment ISA for the long run? I'm only 22, but would love to retire by 45-ish. Right, the first thing to point out is that it's never an either or answer. So you don't have to have one or the other. You can invest in ISAs, you can invest in pensions. It's the same as earlier on when we were talking about income or growth. You don't have to do one or the other. You can do a mix. So somebody who is looking at this person now, they're saying they want to retire at 45. The one issue they do have is you put money in a pension, you won't be able to get it out till they're 55 under the current rules. That could go up. So that does start to change things. Pensions are still probably the best way to fund retirement from a tax perspective, but you can do a mixture of both. So for this person, they may want to look at the idea of investing in an ISA to start with. Again, this isn't advice, it's just telling them to look at the options, look at the access you can have to the investments, look at the way they're taxed, because with ISAs, you don't get tax relief on the way in, but you don't get, you aren't taxed on the way out. Pensions, you get tax relief on the way in, but you are taxed on the way out. So you could, in theory, invest in ISAs and build them up, or investments outside of ISAs if you were doing that. I mean, it's always best to be tax efficient, and you can make pension contributions, bigger pension contributions later if you wanted to, assuming you keep within the limits and you have sufficient earnings. So it isn't always, there are options is what I'm trying to say. But if you want to retire at 55 and you're hell bent on it, then obviously you may be veering more towards investing in ISAs. But I think personally, it's never an exclusive either or answer. Moving on to robo-advisors. Somebody's put, how have the robo-advisors fared during the recent coronavirus outbreak? Have they performed well? To say, because a lot of the big robo-advisors don't put their latest performance figures on their website. And there are actually a number of them that I've noticed have started to change their way they put performance figures on there. So they used to put it on daily, and then when the market completely crashed, I think they thought people were not going to, or going to not understand why markets fall and not want to invest with them. And then suddenly their performance charts turned to the end of 2019 and took away the 3 months, the last 3 months or first 3 months of 2020. So I think at the moment, it's hard to tell their performance figures. Most of them are done up to the end of March. I think they're broadly in line. If I had to say, there'll be individual nuances, but they've fallen just like the market has, just like any diversified portfolio has to a certain extent. Some will have underperformed others. But if your question is there a robo advisor that has weathered this storm to an incredible degree? I've not seen it yet, and I've looked at the numbers, and they've had some quite large drawdowns, just like some of the other managed funds out there. Even things from Vanguard have seen some of their biggest drawdowns in their history. So no, there's no silver bullet when it comes to the robo advisors. The next question is, what are your thoughts on and views on all-weather and golden butterfly asset allocation portfolios, which are meant to do well despite any stock market event? For those of you who don't know, there's a portfolios that were constructed by Ray Dalio. One of them, they're based around holding a set asset allocation forever, and some people think they're almost like the holy grail. And really what happens if you look at them, they're based around holding some equity exposure. Most of it's in the US because it's a US concept, and quite a significant bond exposure with a little bit of gold in there that's thrown in for good measure. Now, I've not gone through and crunched the numbers on these portfolios, and the 80/20 investor research covers things like this. And about 5 years ago, I came up with a bit of research, and I decided, is there a perfect portfolio out there? Ignoring anything else that had been done before, if I looked at the average return from any fund, so it had to be any fund at all that was, regardless of the sector, looked at how it performed since ISAs came into existence in the year April 2000. Was there a combination of assets that meant that you made money in every tax year, a positive return in every tax year? That includes across the fallout from the dot-com bubble, the financial crisis, and even up to now. Obviously, I've updated it, but at that point 5 years ago, it was obviously up to just after the financial crisis. And could it also have outperformed the FTSE 100 over the entire period? And the asset mix I came up with was quite simple. It was a combination, effectively, without giving it away, was of equities, but predominantly, again, in fixed income, particularly gilts, and a bit of cash. And this particular asset allocation it's been tested all the way through the last 5 years, and it's held up, even the tax year that's just passed. So do I think these perfect ideas do work? Yes, they do exist because I created one, but they won't be foolproof, and they have produced very good returns. The one thing obviously we'll say is that a lot of them are based around bonds doing particularly well and continue to be doing really well. And you could argue that we are in the midst of a bond bubble. So just like equity markets have been in a bit of a bubble, collapse at some point, then these portfolios will also struggle. So yes, they work. If you want to look at the perfect ISA portfolio that we created, then you can go and take a free trial of 80/20 Investor. What are your thoughts and views on investing in property funds as part of a pension portfolio? If you've got a diversified portfolio, I can see why you would invest in property funds. There are basically commercial property, so these things invest in either things like buildings, shopping centres. So shopping centres you go to are often owned by funds, and of course these funds can invest in the shares of companies that are related to property, maybe house builders or other companies involved in that sector. The issue you have is the liquidity of these funds. So if you're a unit trust fund that invests in bricks and mortar, so actual buildings, if people want their money out, the way they obviously get the money is they're almost forced to liquidate holdings, and you can't sell part of an office block. And it means that in extreme periods of strain like we've had now, these funds get shut and your money gets stuck in. That's not a positive. But there are investment trusts out there that invest in the same type of thing. And investment trusts, the way they work is that basically you can buy and share shares in these things. They don't have to sell the asset. So when you want to sell your asset or your investment, then somebody else will buy those shares effectively. That's what happens. They're traded in the open market, so you don't have that liquidity crunch. So yes, it can be a good diversifier, but I think it was always best to veer towards other vehicles like investment trusts in order to do it. This is an interesting one. Hey, Damien, what do you see as being the benefits of financial advisors like St. James's Place, when nowadays you can have your pension ISA using investment platforms like Nutmeg, Wealthsimple? Can the traditional financial advisors still justify their 1.5% charge for managing your portfolio, in your opinion? I honestly think financial advisors are going to struggle in the future. Now, the industry as a whole, there's some really good guys out there, and people who follow me know I'm big friends of some of them. I mean, I talk to, Pete is a good friend of mine, and unfortunately, the good eggs like Pete are fewer and far between than they should be. There's a certain level of arrogance about the industry that thinks that they know all the answers and everybody else is ignorant and shouldn't be allowed to run their own money. Financial advice has its place, particularly when you get to retirement, when you're thinking about drawing down. It does add value. It's not a case that the likes of Wealthsimple and Nutmeg at the moment, I think, are in a position where they can completely get rid of financial advice. But we are moving into a world where the cost of financial advice is going to drop, because financial advice has been a very profitable industry. I've worked in it. I know. I've actually worked for financial advisory firms. I know what the levels of commission that they got, and that's obviously been put under pressure over time, and quite rightly so. So St. James's Place is known and is regularly attacked in the press for being expensive, and they will use their own products and platforms and things like that. I think overall, I don't think that for people who are starting out, who are maybe building investments from scratch, I think using a financial advisor isn't necessarily needed, because there are some amazing tools out there and companies that do a lot of this stuff online that can do just what the financial advisor does and provide a portfolio that's diversified, and they actually will recommend it, and it is advice. So they do that at a much affordable rate, and we're going in that direction. Advisors are clinging on to the idea that they want to be able to keep taking a percentage of your money every year for service and reviewing your portfolio. If they do that and they do it well and they add value, brilliant. They also want to take a chunk of your money up front. Normally, that is obviously down to you, but again, it's expensive. For me, if I was to use a financial advisor, I would use them on a basis where I would ensure that when I use them, that the platforms they use, the investments they use, are available to other advisors, and particularly direct to consumers. So that way you can walk away from them and not be trapped in their infrastructure. Because what they do is, if some advisors recommend their own products and their own platforms, they cream even more money off the top. I'd also negotiate fees. Fees are negotiable. People don't realize that. You can negotiate fees with a financial advisor. Trust me, they're going to be under a bit of strain in the future, so you can negotiate it. I don't think they'll be able to justify the high fees going forward, but they do add value. So I am one of the people out there who, I do champion financial advice. People sometimes get the feeling that I don't. In particular circumstances, they add huge value, stop people making mistakes, but particularly if your situation is very complicated and you have a lot of legacy issues, products, but particularly when you're about to retire. So the answer to your question is, can they justify it? I think some of them are struggling in this environment to justify their fees. I think they'll shine a light on the industry even more, that people are wondering, what are these fees for? Because they work as a tax on your wealth. Why are you paying for something if you're not getting the service? And I think people are going to suddenly realize that when they look around, they could have got just as good a service, even on their performance on their investments, for cheaper from other services that are out there. So I think it's only a good thing, and I think there'll be a light shone on them. But I don't want people to think I'm just attacking the industry. But as a whole, I think they're having to struggle to justify their fees, and the good ones will be able to do that without even trying. Because if something is good value, it will hit you in between the eyes. You all know that already. One of the other questions I've got is, let me just check on here. There's some good things. There's some good points on here about discussion on about interest rates, which is interesting. So one of the other questions I just want to finish on, if you've got any other questions, bung them in the bottom because I'll answer them. Somebody has asked, they've been using, actually on 80/20 investor, they've used in the past, there's a tool that shows you the best funds with momentum, so the funds that have the best momentum right now. And of course, in this environment, lots of funds don't have momentum, and they're wondering how could we find funds that are cheap that could rebound the best. So it's a case of finding value rather than the ones that are there now got the best momentum, presumably are more expensive. That is paraphrasing the question, and the person accepts that it's $1 million question. Now, with funds, it's very difficult to ascertain value because they hold so many things. And of course, something could be cheap for a reason. It's because it isn't actually working. Value investing has underperformed growth investing for quite a long time. So value is where you're picking some of the unloved, unwanted sectors, buying them, hoping they rebound. I think it's, for a person trying to pick up value, it's difficult because we're in an environment we don't know what's going to happen going forward. All the old history lessons have almost been torn up because we're in an environment now where stocks and shares that are for certain companies are going through the roof. Amazon, for example, because everybody's working from home and buying things online. So you couldn't have predicted that 6 months, a month ago, really, because of the environment is so different and fluid. So we can't predict what's going to be happening in the next month, because something that's unloved now could be something that's particularly exposed to, let's say, travel. And the travel industry, this, when it goes through the roof, and then suddenly your quid's in. I think that's very difficult, and it is $1 million question. It's difficult to find value tools to help you ascertain value on unit trusts. So one thing I would say, if you're interested in value, then investment trusts are priced differently. So they have a price, and they tell you the net asset value, and it's and also shows you the difference between those, so you can see if something is trading at a premium or a discount. If it's a discounts have widened hugely on a lot of investment trusts, and so you can see what is cheap relative to what's actually owned by the investment trust and make a call. What that can do is identify value opportunities for you, but you need to do your homework to work out why that is cheap, because sometimes cheap can just be cheap for a reason, and that is that it's going to get even cheaper basically in full. So I think that is, I'm just going to quickly look through these questions on the side, see if there's anything else on the side. I see somebody Lynn talks about emergency funds. I recently discovered 3 months of expenses not enough, so I'm building it to 6 months of expenses. Is that enough? $1 million question. I think one of the things for me is I always want to make sure you have, people talk about gross or net income. I think you just want to make sure you cover the bills. The good thing to do is to look at everything that you've got on your expenditure, do it way before it happens. And for a lot of us, this has been a good wake-up call. So we look at the things we could cancel, the things we don't need in terms of bills and expenditure, and then work out what is the minimum you could survive on in terms of paying your mortgage, paying your bills. And then do try, the more you have, the better. That is just going to be a golden rule. So 6 months. I mean, I think what this period has shown is that furloughing, that 3 month furloughing idea, is almost, again, the 3 month concept. If we can, 3 months enough to get through this. 6 months is better. 3 months is obviously good, but it's very personal for individuals. So yeah, I mean, great. If you can aim for 6 months, go for it. Let me just have a look at this one. Greg's talking about fund performance. So looking at funds range of performance from -30 to +15 since COVID. When payday comes, would you be tempted in plowing into the ones that have fallen, or keep spreading it as per normal allocation, 20 plus year time frame? Again, that's kind of going back to that. If something is fallen, could you go and pile in and buy it up? If you've got a huge time frame, then buying at the lows, if the chances are things tend to go up. That's how stock markets work. And there are stock markets that haven't gone up over periods of time. You can just look at Japan, going back to when the market crashed. It's been in a slump for like over 20 years. It hasn't largely gone anywhere. Yeah, there's nothing wrong with that. The only problem is that you're starting to get into the realms of speculating, where you're trying to make almost a punt on something. I know it's a kind of a slightly educated one. Your time frame's long enough, and you are trying to buy something to get the rebound. But I think if there's a process that gets you there, I think that is a far better idea. Gone up higher, can still go up even further. And so I don't think it's just to go and buy things that have fallen. That was necessarily a foolproof plan, but inevitably, if we do go back to some sort of normality, those things that were hampered because they are exposed to particular industries could potentially do better. I've reached the end of this Q&A. If you have any other questions, then please do send them in. On any topic, it doesn't have to be investing. We will try and do this again next week. If you want to do it again, please do send in your questions. Please keep emailing them. I love doing this. It's fun. I think it's why I do it. Don't forget to listen to the podcast. Share this with as many people as you can. So until next time.